All right, let's talk about a company we all know. I mean, its name literally became a verb during the pandemic, Zoom. But for investors, man, it's been a tough ride, a classic fallen angel. The hype is long gone, the stock's been crushed, and honestly, most people have just written it off. But what if the story the market is telling us is just completely wrong?
And this image just nails the conflict we're digging into. On one hand, you have the market screaming, "Sell, get out!" You can see it in the stock chart. But on the other hand, you have the company's actual finances, the balance sheet, kind of whispering, "Hey, over here, you should buy." So the big question is, who's right?
To figure that out, we have to start by tackling the biggest cloud hanging over Zoom, this idea that it was just a pandemic darling, a one-hit wonder whose best days are long gone. So let's pull that whole narrative apart.
Now just look at how brutal the market's verdict has been. It's kind of stunning. While the Nasdaq has been soaring, up over 80%, Zoom's stock has just been pummeled, down more than 74%. I mean, that is a massive, massive disconnect. If you only looked at this chart, you'd think the business itself must have totally imploded, right?
Well, not so fast, because when you ignore the stock price for a second and just look at the actual revenue, you get a totally different picture. We're talking about a jump from just over $500 million in 2020 to a projection of almost $4.7 billion in 2025. That does not look like a business that's collapsing. It's a business that is still growing, and with these incredibly healthy 75% gross margins. So yeah, that whole growth is dead story, it seems a little exaggerated.
So, if the business is actually doing okay, what else is the market missing? Well, for this, we've got to pop the hood and look at the engine. We need to look at the company's financials. And honestly, the only way to describe them is a fortress.
Just check this out. For every $4.6 billion in revenue, Zoom is spitting out over $1.8 billion in free cash flow. And that's the good stuff. That's the actual, real cash left over after you pay all the bills. See, this isn't some pie-in-the-sky growth stock anymore. It has quietly turned into an incredibly efficient cash-printing machine.
And where does all that cash go? It goes right here. This visual just says everything, doesn't it? The scales are just ridiculously tipped. On one side, you've got this mountain of cash, and on the other, almost nothing, barely any debt to speak of. It's not just a strong balance sheet, it's a financial fortress. And let's put a number on that mountain of cash. It's $7.79 billion. Now, to put that into perspective, that cash alone makes up about 27% of the company's entire market value today. Just think about that for a second. More than a quarter of what you'd pay to buy the entire company is just sitting there, in cash. And management isn't just letting that cash sit around, they're putting it to work. As you can see here, they're taking that cash and basically feeding it into a machine that buys their own stock right off the market. This reduces the number of shares out there, making each one that's left a little more valuable. It's the company basically saying, hey, we think our stock is a fantastic deal right now, so we're going to be a buyer.
Okay, so the financials are solid, but what about that other big criticism, right? That Zoom is just a one-trick pony and everyone's got a video app now, especially Microsoft Teams. Well, let's look at their strategy to move beyond just being the video call company.
This is the big vision. It's called Zoom Workplace. It's not just about meetings anymore. They've built out this whole ecosystem. They have Zoom Phone, which can replace your entire office phone system. They have Team Chat, Zoom Docs, a contact center for customer service, the whole shebang. The goal here is to become the central hub, the main operating system for how you get work done.
So how on earth does it compete with a behemoth like Microsoft? Well, the answer is right here in this quote. Zoom's whole strategy is to be the Switzerland of work software. It wants to play nice with everyone. Google, Salesforce, you name it. Its defense isn't about building a bigger wall. It's about being the neutral, simple platform that just works with everything else you already use.
Now, a solid business and a smart strategy are great, but let's be real, in today's world, you need an AI story. And it turns out Zoom has a very, very clever ace up its sleeve here.
And this is where it gets really interesting. Look at the contrast. Microsoft is all in on OpenAI. They're locked in, which means high costs that they have to pass on to you with expensive add-ons. Zoom is playing a different game. They have what they call a federated AI approach. That's a fancy way of saying they can use any model they want. OpenAI, Anthropic's Claude, their own stuff, they use whatever is best and cheapest for the job. That flexibility could be a massive advantage down the road.
But all of this, the cash, the platform strategy, the clever AI approach, it still doesn't cover what might just be Zoom's most valuable and most hidden asset. And here it is. Way back in May 2023, Zoom quietly invested $51 million in a little AI company called Anthropic. Well, that tiny seed has bloomed into a giant tree. Today, the estimated value of that stake is somewhere between $2 and $4 billion. That's a potential 78x return on their money. It's absolutely insane, and it gives them a front-row seat to one of the top AI models on the planet.
So here's why that matters so much for the valuation. Let's do some quick math. The whole company is worth about $28 billion on the market. Now let's just subtract the cash they have, that's almost $8 billion, and then let's subtract the value of that Anthropic stake. Let's be conservative and say $3 billion. What are you left with? You're left with a price tag of just $16 billion for the actual core business, a business that, remember, is generating $1.8 billion in cash every year. That is an incredibly cheap price.
So let's pull all of these pieces together. Let's build the final thesis on where Zoom really stands today. Is this a story of evolution, or is it a story of extinction?
The whole investment thesis really boils down to these 5 key things. First, the product is sticky. It's a machine that's deeply embedded in how companies operate. Second, that machine is a cash factory, just churning out money. That cash builds the third point, a fortress balance sheet, which gives them a huge margin of safety. Fourth, you have that hidden gem, the Anthropic stake, which is like getting a free lottery ticket on the future of AI. And all that together creates the final point, a really interesting asymmetric risk.
And this table just hammers the point home. Look at the price-to-book ratio, basically what you're paying for the company versus its on-paper assets. Back in 2020, people were paying 25 times its book value. Today, it's less than 3. This massive shift means that Zoom, the former hypergrowth darling, is now trading deep in what we'd normally call value stock territory.
So in the end, it all comes down to this crossroads. One path leads to stagnation, where Zoom just becomes another video app that nobody really cares about. The other path leads to evolution, where it becomes a true AI-powered platform for work. The risk of it being a value trap is definitely real. But when you look at the cash, the strategy, and those hidden AI assets, the evidence suggests the market may have punished it way too much. The final question for every investor is, which road is Zoom really on?